Welcome to this video class. I would like to explain you a lot about financial ratios and how to use financial ratios. And how should we do that? I use an annual report, in this case of Burberry. The Burberry Corporation, established in England, is a well-known fashion company. Okay, first of all, I would like to discuss the annual report of Burberry. Here you see some pictures of the beautiful shops in London and the kind of products they're sold. It's not all of their things, but there's also some of their handbags. So here we're gonna start with analyzing financial statements. First of all, we need to get a closer look at the financial statements. So first we look to an overview of relevant financial statements of Burberry, the balance sheet, the income statement or P&L account, and the statement of cash flows. Then we will discuss how to calculate the common size statements or component percentage. And then we go in 4 steps about the commonly used ratios. We'll talk about profitability, liquidity, solvency, and something about market tests. So let's start. Here we see the balance sheet, and for all, this is a UK company. So they start with the non-current assets like intangible assets, the value of their purchased trademarks. We get property, plant and equipment. We get the investment properties. They're talking about deferred tax assets, and they talk about trade and other receivables. Customers who you delivered already goods, but on the other hand, they had to pay for the goods still. And then we get derivative financial assets. I don't know exactly what it is, so I always stay far away from derivative financial assets. Think about interest swaps, valuta swaps, and etc. Besides the non-current assets that stay for more than a year in the company, we've got also the current assets. The assets that are with the company shorter than a year. We're talking about, for example, inventories. Are those important? I think so. If your aim is producing stocks and trying to sell these stocks to other persons, then inventories would probably extremely important. So the trade and other receivables, so that means the money you receive from customers within a year. Then we get derivative financial instruments, and then income tax, etc. And then finally cash and cash equivalents. So that actually means your cash in hand and your cash on bank. That all made together with the asset classified as held for sale. That means, for example, a shop you would like to sell to someone else, and that's located in Hong Kong or in the outer skirts of London. So that are assets held for sale. The total assets are something like 1 point, and etc. Those assets are financed by liabilities and financed by shareholders' equity. So the liabilities, we could divide them up in non-current liabilities. So that means that's longer than a year, and the current liabilities. So of course we get there the creditors, the trade and other payables. You have to pay within a year or later than a year. So on top of that, we get, for example, the deferred tax liabilities, the derivative financial liabilities. Derivatives, always a little bit tricky, but okay, stay away if you don't know exactly what it is and what it could do or how it harms your company. Then we get retirement benefit obligations. That's for me. I hope I get on retirement within 2 years, and hopefully the company organized something for me. So that are the retirement benefit obligations. The obligations which you have to pay to people who are retired in your company. And that's on top of what the state paid them. Then we get bank overdrafts and borrowings. So that means in the current liabilities, on the short run, you have to pay back your bank. Then we get the trade and other payables, payable within the next 12 months. And then we get provisions for other liabilities and etc. Then we get some income tax liabilities. We had to pay income tax. Even Burberry has to do it. It's not always Starbucks. So then we get the equity, the ordinary share capital. So that means the ordinary shares. Then we get the share premium account. That's if you issued shares and the price is higher than the face value on it, the difference between the selling price on the market and the face value on it. We call it share premium account or premium account. Then we get a capital reserve. We put all the reserves together. Then we get a hedging reserve. We get foreign currency translation reserve. Sometimes we win in regions outside the British pound. Sometimes we lose some. And then finally we find out the retained earnings. That is all the profit we made of the last few decades and years put together minus the dividend we paid out. And then we get a non-controlling interest in equity. It's 24.1. What does it mean? Non-controlling means this is not only Burberry, but this is the consolidated balance sheet of Burberry and all of its other economic entities. The Burberry Group is seen as an economic entity, and they consolidate the assets and the liabilities of other companies. That's good. But sometimes they own a company, for example, for 90%. But even then they consolidate 100% of the assets and 100% of the total liabilities. And the difference they correct for is a non-controlling interest, an NCI. So, and that's in this case 24 for all those companies together. Okay, here we see the income statement, and that really makes sense, but we're gonna discuss that more in detail. They got a revenue of almost £2 billion, and they got a profit for the year of 265.1. That's great. So, then we see here the statement of cash flow. That means cash going in and cash going out. In this case, you can directly see that this is an indirect statement of cash flow. The question is, why could I see this directly? They start with the operating profit and then correct, for example, for depreciation, for amortization. Remember, depreciation and amortization are expenses. And these expenses did not lead to any cash outflow this year, but there was already a cash outflow in the previous year. One eye, purchased property, plant and equipment. It was already cash out. It's now an expense, and this expense is not a cash out. So if I would like to make from my net income, from my operating profit, a cash flow, what I should do is take my operating profit and add those expenses that are not cash out with a plus. Then we get the changes in inventories, changes in payables, changes in receivables, and that make me the cash generating for operating activities. Then we get the interest received, that's one. Then we get the interest paid, then we get the taxation paid, and I see the net cash generated from operating activities is 373, and that's good. That's higher than the net income. So the earnings quality, we're gonna see later, is good. So then we see the flows from investing activities. Purchased property, plant and equipment, that's cash out because you purchase them, so your cash is going out. Then on the other hand, we see that we get also the purchase of intangible assets, again cash out. And the acquisition of a subsidiary, net of cash acquired, that's something like 20. So I get 170 cash out for my investing activities. Then I'm going to look at the financing activities. Financing activities mean you borrow money from a bank, so you receive money, that's a plus. Or you pay back your debts, that's minus, or between breaks, or by the way. So if you pay dividend, it's a cash out. We see here in the first sentence, dividend, that's out. Then we see, for example, dividends paid to non-controlling interest, that's also out. Then capital contribution by non-contributing interest, that's nice. And then we get also the purchase of own shares. What actually Burberry is doing, they're purchasing on the market own shares. And they pay out dividend to satisfy the shareholders, but also pay back own shares. And they do that in a kind of program. Reason for that is to increase the share price. Okay, and then we get some remaining borrowings, that's nothing. So the net cash outflow from financing activities is 1,543. So that's 154. That's good. That's cash out. Merely to dividends and purchasing of own shares. Then we get investing. They're still investing for 176. So that's good too. So that actually means that there is a net increase of 42. So I get increase operating activities, 373, decrease by investing activities, decrease by financing activities. By the end, the net increase is something like 40. At the beginning, we get a cash at the beginning of the year plus the increase, and that gives the cash and cash equivalents by the end of the year. And you can find this figure finally back on your balance sheet. So, okay, here we see cash and cash equivalents at the balance sheet date, bank overdrafts minus cash and cash equivalents in the statement of cash flows, it perfectly matched, and then we see the net cash. A perfect overview of the cash flow statement with all the references to the balance sheet and even to the income statement, because this statement is indirect. Okay, if we've seen this, I would like to discuss and focus a little bit on the income statement. So express each item on a particular statement as a percentage of a single base amount. So these are the common size statements. So that means that you don't use the absolute figures, but you create a set of relative figures, and that's related to what? That's related to the net sales on the income statement, or the total assets, or the total liabilities and shareholders' equity on the balance sheet. So what you actually do, prepare component percentage income statement, whereas the sales are equal 100%. That really matters. Let's show this. We see here once again the income statement. So we say the net sales, the revenue in this case is 100%. Referring to that is that the cost of sales, so the cost of preparing all those luxury goods at Burberry, is something like 30%. That's not even 1/3. So you buy something in the shop, excluding taxation, you're paying 30%. So you're paying, for example, £1,000, and then you know it's an average product, then it's made for approximately £300. So they make a gross profit of almost 70%. That's particularly huge, even if you compare these kind of figures to Louis Vuitton or Hermes. Then we get the net operating expenses. Think about marketing, think about general and administrative expenses, think about selling expenses. They're all included here. And we see that this is almost 50%. So almost 50% at Burberry is going to the operating expenses. And then we get the operating profit is something like 20%. That actually means you buy something for approximately £1,000, so £200 is what? Yeah, you see it. That's what we called the operating profit. Then we get the financing things and etc., and the profit of the year. But now it's time to go back. We just discussed component percentage. They always mention common size, but you express a statement of income as a percentage of the sales, so this gives you an extremely nice overview. We find that gross profit is almost 70%, that the operating profit is 20%, and that the profit for the year is approximately 14%. That means if you buy something of 1,000, 140 is profit. We also could do this for the balance sheet. There we take, for example, the intangible assets compared to the total assets, and there we find a certain percentage. I would like now to continue with commonly used ratios. There are 4 kinds of ratios, and I'm particularly interested in the first 3. The profitability, liquidity and solvency. A market test, I really believe on it, but predicting the stock market is probably the most difficult thing around. So if we're talking about profitability, you've probably ever heard about the return on equity, the return on assets, the financial leverage percentage, the EPS, the earnings per share, which you could find in every income statement, and the diluted earnings per share, if you take into account that you get convertible bonds, that you hand out shares as a bonus, and etc. We're talking about the quality of income, talking about the profit margin, but we did already that. And we're talking about the fixed asset turnover ratio. How many assets are necessary to get, for example, a little bit of sales? In the aircraft industry, you know, an aircraft is extremely expensive. But in the aircraft industry, wake up, stay alert, it's 1. That means if you got in a certain year an aircraft, and the aircraft flies up and down from Paris to London, and back and forth on, and etc. And it does a year that the total sales are almost equal to the total cost of this, or the total value of this asset. That's actually mean it. And I know if you fly with an extremely old ratio, with an extremely old aircraft, this ratio goes up. Then we're talking about liquidity, cash ratio, current ratio, quick ratio, receivable turnover, inventory turnover. We're talking about solvency times interest earned, cash coverage, debt to equity, market tests like price earnings and dividend yields. Okay, let's start with the profitability. And we start with the most important measure and used overall, the return on equity. Return on equity is nothing more and nothing less than the net income divided by the average stockholders' equity. And what is average? The average is the beginning of the year and the end of the year. So you take the balance sheet of the previous year, the end, and the end is the beginning, and you take this year's end. This measure indicates how much income was earned, and I think for every dollar invested by the owners. The net income in the income statement is 265 divided by the average stockholders' equity. I take the stockholders' equity at the beginning and the end of the year divided by 2, and it gives me 812. This times 100% gives me something like 33%. This is extremely high, but don't forget Burberry is doing extremely well. The return on assets. In all kinds of scientific research, the return on assets is an extremely valuable measure because on one hand, this excludes the way of financing. The net income plus interest expense divided by the total assets. So the net income is 265 and the net income and the interest expense is something like 3. The total assets divided by 2, so the average, the beginning and the end of the year, gives me something like 1.6 plus 1.3 divided by 2, and that gives me an extremely nice percentage. So important is this. The return on equity is something like 30.3 and the return on assets something like 17 give me 14%, and that's what we call the financial leverage. Interesting above that is you find it in every financial statement and every income statement, the earnings per share. Earnings per share is nothing more, nothing less than net income divided by the average number of shares of common stock outstanding. You take the beginning and you take the end of the year and you take common stock. Yeah, important because every nation has got all kind of different stocks. Think about Sweden, think about Holland. They're always messing up these kind of numbers a little bit. Earnings per share, the most widely watched financial ratio because it's given and disclosed in the financial report. The net income is not that difficult, but the average number of shares, it was difficult for me to find it. But I go through the annual report and finally I find the graph. And in the graph the EPS was given. So what I could do is net income divided to something is a certain point of EPS. So then I could easily calculate the number of stocks outstanding. Cash flows from operating activities, you had to compare this with net income. What is it? To be honest, this is a quality of income. This means net income is revenue minus expenses. The cash flow is cash in minus cash out. If this is close to each other or the cash is higher than the net income, it's perfect. It's real perfect. Let's see. The cash flow from operating activity was 373.7 divided by the net income 265.1. And this is 1.4. This is great, Burberry. A ratio higher than 1 indicates a high quality earnings. This means that all those accounting measures are done extremely properly and prompt. So there is a slight difference between cash, that's 1, and net income. Then we get the profitability margin. We already discussed this. This ratio TEL is a percentage of each sales dollar that is income. And here we're talking not about dollars, not about euros, but about pound sterling, because it's England. For God's sake. And important, the net income is 265.1. The total sales, the total revenues in this case were 1.8 billion. And it gives me 14%. 14% means that on every dollar, on every euro, on every pound sterling, on every zloty, on every thing you spend at Burberry, and take for granted that this is an average product, it means that 14 cents is directly going to the net profit. After deducting all costs, after deducting all marketing, that's left for the owners of Burberry. Another thing are the tests of profitability, are the fixed asset turnover ratio. You know, we're here in clothing and in exclusive clothing, and we're here in accessoires. So we take the net sales revenue divided by the average net fixed assets. What is net sales? Net sales or sales revenue or revenue, net revenue means that it is excluding the value added tax, the VAT, divided by the average fixed assets, and we put that out of the balance sheet, and there we find, okay, non-current assets. We take the beginning, the end of the year divided by 2, and it gives me something like 344. So every pound sterling, dollar or euro in sales is held by 1/3 of assets. Or in the other way around, you could say, if I invest on average $1 in fixed assets, that's important, that gives me $3.44 in sales or revenue. Then finally we're here at the test of liquidity ratios. To talk about the cash ratio, it's not that commonly used, but it really gives you a good idea how liquid the company is. Are you able to pay back your liabilities and your payables within the next few days? Let's have a look. I take cash, cash on hand, cash in bank, and all the cash equivalents. That are all kind of assets that are extremely close to cash. For example, you get all kinds of money drafts with states and with other banks. Let's see, the cash equivalents, 546.9, divided by all kind of current liabilities. And we find that this is not 1, but it actually means that this is perfect. This is great. Then the current ratio. The current ratio, you probably have already seen this on high school. So the measurability of the company to pay the current debts as they become due. So there's more within a year, are you able to pay back your debts? And the issue is, yes, you are. But you know, your cash is also going up and going down and up and down. And that's also here. So it's a good measure. But there are measures that are better. For example, the previous measure. Or, for example, the quick ratio. But we take here and we find out that the current assets divided by current liabilities, the current ratio is not 1.8, that is extremely good, but 1.7. So that's still extremely good. I would like to have that for my current ratio. Now I go to the one I really love, because this is even in the Dutch law. The quick ratio. Quick assets divided by current liabilities, but I don't know what quick assets are. Help me out. I help you. The cash and cash equivalents, the receivables, net of any doubtful receivables from people you probably never get your money back. That is receivables net. That's not included, of course. The short-term investment. You invest like Apple. You don't know what to do with all your money, and you invest it on the stock exchange and bonds and shares and stocks and whatever. And you put it all together, and we call this quick assets in this case. So this is 692, and we divide it by the current liabilities. I already know that that's higher, so that's good, 1.16. what I normally learned at high school and even later on at university and Polytech University and at the executive education, that quick ratio has something like to be 1.2, and this is close to 1.2. The current ratio is something like 1.8, and it was 1.7, so they're extremely strong, even in situations of crisis. Then we get something like the receivable turnover ratio, the net credit sales divided by the average net receivables. If it's B2B, it's not a big issue. And here it is, we're talking about receivables. To who is Burberry selling? Don't forget to ask you that question. They're selling to you, they're trying to sell to me. And we had to pay cash or by credit card or whatever. So this is a little bit doubtful ratio in this company. Be aware, net credit sales divided by the average net receivables. How quickly did I collect my money? And we assume that all sales are on credit. We know that it's not true. We take the average net receivable, longer than a year, shorter than a year, and then we find out that it is particularly good. Then we get the inventory turnover ratio. That's good. What is inventory turnover? How many times a year do you sell your inventory? And don't forget we're in clothing. And clothing has to be changed at least every semester, or preferable every quarter, and even faster of course, because I had to live. 558.3 divided by the average inventory gives me 2 times. Shocking, but that's correct. If I went to my granny, what I see there is she's still proud in it, and I was not able to get it for now, but her handbag from 50 years ago. So people sell something, but it is actually mean that they only sell their products 2 times a year. So that's slow. But on the other hand, their thing, what real makes Burberry is quality. And on the other hand, it's framed in something like we called a perfectly suited thing. So probably these 2 things together make that the inventory turnover ratio is extremely slow. This means actually that products are at least on average 180 days in the production facilities and in the shops. So it takes 180 days before production starts and before it's sold. Take production 2 months, then it's 4 months still in the shop. I think that's a little bit long, but okay. Then we get the times of interest earned. Take all the net income, interest expense, income tax expense, perfectly divided to the interest expense, extremely high. Why? Because the company did not have that much interest-bearing things. Okay, then we get the cash flow from operating activities divided by the interest paid. Yeah, still the same thing, because the interest paid is so extremely low in this case that you get an extremely high financial ratio. Then we get the debt to equity ratio. Total liabilities divided by the stockholders' equity, and we're gonna see that this is 0.8. This is a good solvency. This is real what banks like. Your solvency extremely well, so people would like to invest in you. So some market tests, so that's the last one. The current market price per share, every day different, divided by the earnings per share, give you at least an idea how it is. So this means current market price is that, earnings per share is that. So give me something like that. Is that good or wrong? I would be extremely satisfied with that. Dividends per share divided the market price per share, something like that. Okay, the share price, right out of the annual report, and it gives me 12.2. I would be happy with that. We now discussed financial ratio of Burberry, and we had to be aware that I did not compare this company to, for example, Hermes. I did not compare the company to Louis Vuitton Moet Hennessy. I did not compare the company to other things I did not even compare the company over time. So actually this is quite useless. But what is important, you could do a better job. Compare this business unit with another business unit, or your listed company with another comparable listed company, or compare your company over time. How is the performance of management? So that's important. And don't forget, ratios are based on a balance sheet, which is a picture of one moment, and on a profit and loss account, which is a little movie over time. Put these things together and you see that financial ratios changes every month or probably every day. So once again, what did it state here? Ratios may be interpreted by comparisons with ratios of other companies or with industry average ratios, with benchmarks. Ratios may vary because of the company's industry characteristics, the nature of operation, the size, and of course accounting policies. If you do extremely aggressive accounting policies, your profit would be increased. In addition to financial ratios, special factors might affect the company analysis. For example, rapid growth, uneconomically expansion, and all kind of subjective factors that all influence those financial ratios. But at least it gives me an idea if I could interpret some of these ratios month after month. I get an extremely well overview of this company. And this is real what managers on the floor need. Week by week, all kind of ratios, because the ratios we mention here are for listed companies, but also internally used ratios, like economic value added and that kind of stuff. Like all these kind of issues are important. Thank you for watching and gonna see you next time back in class. Bye. My name is Bob.